Hello and welcome to CIO Perspectives. I'm Sid Ahl, the co-CIO of Private Clients, Endowments and Foundations here at Brown Advisory. And today I'm joined by two of my colleagues, Kif Hancock, our international CIO based in London, and Sarge McGowan, CIO for our U.S. Endowments and Foundations. We're just past the halfway point of the year, which makes this a great opportunity to step back from the daily headlines and discuss what's really shaping markets today. So we're going to cover everything from geopolitical tensions to artificial intelligence to inflation, central bank policy, global opportunities, and what we're hearing from clients. So, Kif, let's kick it off with you. As we hit the midpoint, what's occupying most of your attention?
Thanks, Sid. I think the biggest thing occupying my attention is how to position portfolios for AI without abandoning our long-term investment philosophy. And let me tell you what I mean by that. I continue to believe that AI is still in its installation phase, which has two important implications. But before getting to those, let me quickly explain what I mean by an installation phase. There's a framework that suggests that major technological revolutions unfold in two broad stages. The first is an installation phase, when capital pours into building the new technology and its supporting infrastructure. And then that is followed by what we call a deployment phase, where the infrastructure is applied more broadly across the economy and it begins to spread the widespread productivity gains. But what's interesting is that each phase can last many years, if not decades or more, and that duration has implications. The first implication is that a meaningful portion of today's winners may not be the set it and forget it investments, and I'm referring to the Buffett-like model of buying a world-class business and holding it for the long term where, for lack of a better description, time is the friend of a wonderful business. Those businesses certainly still exist, but with AI in particular, the technology is evolving so quickly and the leadership across the ecosystem may change so substantially that I think investors will need to adapt as the opportunity set evolves. The second implication is that if this installation phase lasts for many years, and I suspect that it may, and we talk about this pretty often these days, we may still be in the early innings of a much broader AI infrastructure build-out. And that creates an interesting challenge for us here at Brown Advisory. Our philosophy has always been built on owning world-class businesses for the long term. And don't get me wrong, we continue to do that. But I think capturing the AI opportunity may also require adding strategies that provide more direct exposure to this build-out, rather than relying solely on our traditional holdings. It's one of the more difficult portfolio questions we have faced in years, actually. And if AI continues on its current trajectory, I think insufficient exposure could mean missing some of the most meaningful sources of return, particularly because many established strategies are not directly positioned for this build-out. So on the other hand, the skeptics prove right, and this doesn't last. I think our portfolio should still benefit from meaningful diversification. But I think we just have to be cognizant of having some exposure to some of the business models that are really leading the market today. And that really dominates, I think, most of my thinking during the day.
Yeah, it's really interesting. We've talked about this as almost a coverage issue for many strategies where our traditional philosophy of focusing on great businesses, of high quality, free cash flow generation, clean balance sheets, that leads many of these managers to just not cover areas like semiconductors or some of the energy infrastructure. And so it's less about are these or can these be great businesses in some cases and more about coverage. It's a really interesting way to kick it off. Sarge, what about you?
Yeah, one of the things that has really jumped out to me through the first half of the year is just that it's been another strong start to the year for risk assets. And I think that was not obvious. You get to June 30th and look at numbers through the first half of the year. The S&P's up a little over 10%. Global equity indices, the MSCI All Country World up a little bit more than that. Areas like emerging markets and small caps in the U.S. up 20% plus. And in private equity, we're seeing signs of improving marks and performance moving in the right direction. So if you just didn't pay attention to what was happening through the first 6 months of this year and just looked from point to point, it would look like a broader market that has been quite healthy. And I think in some senses that's correct. But the broadening out, I think, is not happening as much as you might think. This is still, as Kif pointed out, it really has been an AI build-out story. Emerging markets, I think, is a really interesting example of this, up 20% plus in the first half of the year. There are three semiconductor stocks, TSMC, Samsung, and SK Hynix, which have driven over half of this return. They are now over 30% of the index for emerging markets. Small cap is a similar story. So there has been some broadening out. There's been some good earnings growth across the board, but semis and AI related companies are really driving a lot of that growth. To be clear, this is not just a price story, it's an earnings story as well. There is earnings growth underneath and really underpinning the stock price growth. And so that makes it a really interesting dynamic. So with that in mind, it's really quite similar to what Kif just said. We're thinking about how we position portfolios in this environment. And on the one hand, we need to be sure that we have exposure to AI and to this AI build out phase for our endowment and foundation clients. And we're getting that exposure. We get it through active managers, a bit through passive. We get it through some of our private equity managers. But we also want to be sure that we're looking for opportunities elsewhere as well. I was on a plane last night flipping through a few investor letters that have come out after the second quarter. And two of them jumped out to me. They were quite similar, managers that I think are not exactly the same, but both longstanding, more quality-oriented managers on the public equity side, talking about how their portfolios are about as cheap as they've ever been. And growth is still positive and still strong. And the issue is they've had a few AI losers or perceived AI losers in their portfolios, and that's driven their portfolios down over the last 6 to 18 months. And I think we have to leave space for having investments like this and space to be able to add to investments like this when opportunities present themselves. So it's really finding that balance between what is such a dominant theme and the rest of the world and the rest of the market. Because in the end, what we're trying to do for these endowment and foundation clients is build balanced portfolios that can perform in different market environments. And we want to be sure we're not tied too tightly to just one theme. Sid, what about you?
You guys have hit a lot of what I was going to talk about. I'm trying to hold those two ideas in my head at the same time, which is one, that my priorities 1, 2, and 3 are understanding what's going on in AI because of the importance to markets, but also realizing that a lot of investor attention is being taken towards these areas. And there are a lot of forgotten sectors, companies in payments, obviously some in software and other areas that look like they're getting very, very cheap, and where some of our managers are telling us the opportunities are really compelling. But on the AI point, it's just the stakes are so high right now for the U.S. economy and markets, which is why I spend so much time thinking about it. Probably half of U.S. GDP growth is coming from this AI infrastructure build out. More than half of S&P 500 earnings, and you just quoted emerging market earnings. I mean, it's in some cases 60, 70% of the earnings is coming from AI-related companies. And this AI spending is also entering a different phase where it's becoming more reliant on borrowing and capital raising rather than just the free cash flow from the big tech companies. We're likely to see free cash flow of the big tech companies this year approaching zero. And in some cases, it's going to go negative with companies like Meta and Amazon. So these companies are all in on this build out. And to be fair, they have very solid balance sheets with the exception of, say, an Oracle in order to fund it. The debt levels are still pretty low. This can go on for quite some time, and they clearly expect it to. So I think really the questions everyone needs to be asking themselves is, question one, is there real value coming from this spend on AI? Are companies seeing a benefit? Two, are the revenues going to these AI companies outstripping the costs of the build out? So, are we seeing a good return, a positive return at least? And then three, how long do we expect this build out to continue and at what pace? How much compute do we need? Some people have said the demand for intelligence is infinite. And if compute equals intelligence, perhaps this goes on quite a long time. But if you think there's not a lot of benefit to AI, or the returns aren't as good, or the build out is near completion, you should probably have some real concerns about equity markets and the state of the economy today. If you believe, as I do, and I think many of us do, that companies are starting to see a real and growing benefit, returns are likely to be good, and the build out's going to exceed expectations in terms of its pace and size in the next 2 to 3 years, then the outlook remains fairly positive. It's just very reliant on the AI build out. So for me, the last few months have been all about building out a dashboard, trying to get more real-time indicators of supply and demand in AI, tracking revenues versus costs, looking at rental rates of GPUs and prices being spent per token, looking at modeling the growing expectations for spend. And honestly, it's just all consuming because the stakes are so high. And I've also recently been thinking a lot about if there's some point at which the hyperscalers, who are basically paying all of their free cash flow over to the semiconductor companies and the infrastructure companies, while their stocks are not being rewarded for it, might they blink because of the pressure and slow their investment pace? Now, to be clear, I don't think they will blink. I think given the founder mentality of those that are in charge, the solid balance sheets that they have, I don't see it happening, but it could. And that's something that I'm thinking about a lot. And then, Sarge, to your point, as positive as I am on AI, the data that I'm seeing is showing a bit of a softer economy overall. And I'm a little concerned about how reliant we are on this one factor. As I just said, the jobs market has gotten a bit weaker. Unemployment rate is staying steady, but it's mainly because people are leaving the labor force. A crazy statistic is that there's basically the same number of full-time employed workers in the US today as there were 3 years ago. I mean, zero growth. And that's because people are dropping out of the workforce. Couple of statistics for men aged 55 plus, it's the lowest participation rate we've seen in 25 years. A 2% drop of that participation rate just this year. The only time it's been lower is in the early 90s in the recessionary period. And most of the new jobs we're creating are lower wage healthcare jobs. The housing market's also pretty weak. Housing starts are at their lowest levels since COVID. And also for the first time since COVID, because of this recent spike in inflation, wages have been growing slower than inflation. So we've seen a bit of a real income shrinking. The government deficit has also been shrinking, a peak of nearly 7.5% last year to more like 5.5% today. So there's been a bit of fiscal tightening. And so these are all somewhat concerning for the growth outlook, and they add to the pressure on AI being successful. Another staggering statistic, it rhymes with what you were talking about, Sarge, is over the last 4 years, earnings in tech and communication services companies in the S&P 500 are up 2.5x. Earnings in the other sectors, all the other sectors, are up about 15%. So while I'd love to be seeing this broadening of growth and earnings and market performance, as you pointed out, a lot of it is still being driven by AI. And I do wonder if we have the fundamentals today that set up for that broadening, given the reliance on this AI cycle. I think that the hope that we all have, maybe I'd even say it's an expectation, is that AI productivity across a multitude of different companies and sectors may start to shine through. At the end of the day, if AI works, it's going to be every company that's going to be able to utilize it and benefit from it. Last thing, we're recording on July 15th, 9 o'clock in the morning. We just had an inflation print yesterday, and I think we should call it out that was one really good piece of news for the markets, is that we actually saw prices decline during the month of June, and inflation expectations the next 12 months are right around 1%. So despite market expectations for the Fed starting to hike rates, the pressure for them to do so with a new chair is falling a bit, and I do want to call that out. But Sarge, before we go deeper into this AI conversation, and I'm sure we will, markets and our conversation thus far has moved pretty swiftly past the concerns of the war in Iran, the closure of the Strait of Hormuz, and despite some pretty dire predictions from many oil and commodity experts, it seems that many of those experts and analysts got a few things wrong. One being the ability to reroute oil through the Middle East pipelines. Two, the willingness of many countries, particularly China, to curb their consumption and use down their oil reserves. And then the last thing is the ability to actually sneak through some ships, despite Iran's best efforts to shut down the strait. What's your take on the impact thus far and how this plays out and how much you care about it for the portfolios you're designing?
Yeah, good question. I think it's a nice reminder that we seem to get over and over and over again in this business, how hard it is to predict outcomes that are related to commodity prices and geopolitical events. So for us, we do care a lot about what is going on. We're watching very closely what's happening in the Middle East because it has real implications for global economic growth, for inflation, and for risk premiums in equity markets. You mentioned the recent inflation print, and that was good news. On the inflation side, I think this is also a reminder that inflation could be a little tougher to shake, not moving back to levels we saw a few years ago post-COVID, but could be a little tougher to shake than what some people may be anticipating. And if you think about, for the three of us in most of our investment careers, we had decades of globalization, which was hugely deflationary. We had ultra low rates after the financial crisis in 2008. For me, it's hard to see us going back to an environment where those things fall back into place. There's more friction in the world than I think there was generally as it relates to inflation during those periods. I don't think we're going back to that. So I do think that some level of inflation is likely here to stay, and it may be driven by things like AI build out. It could be driven by food prices, the Ukraine, Iran, a number of different things. But I think some level is going to be there, and it's something the Fed and other central banks are going to have to fight. So in terms of what we're doing in portfolios, we don't really move portfolios around. We weren't repositioning when oil hit 110. We weren't repositioning when it hit 70. It's now back up close to 80. And so we're watching this. We're trying to understand implications for global growth, but we're not making material changes to the equity parts of our portfolio. And in fixed income, I just say, kind of given that view on inflation, we're probably more range bound here than anything else. And so we've taken a pretty neutral view in fixed income and keeping duration relatively similar to that of the ag benchmark.
It's interesting to think about one of the drivers of inflation perhaps being the one area that was consistently deflationary for the last 50 years, consumer electronics and electrical components. The memory price surge is going to lead to iPhones and laptops and all things electronic going up in price when they typically go down. Kif, what about you? How much are you still focused on this story? Is it over? And then from an international perspective, clearly Europe and Asia were hit a bit harder. Are you seeing companies and investors outside the US viewing these risks differently?
Yeah, maybe slightly differently, maybe more acutely, and I'll come on to that in a minute. It's interesting because last night I had the opportunity to speak with Sir Robin Niblett during a panel discussion here at Brown Advisory's London office. And for those that don't know, Sir Robin has been one of the UK's leading voices on geopolitics for some time. He spent 15 years as Director Chief Executive of Chatham House, so he's far more attuned to insights on these issues than I am. And what struck me was one of his observations, and I found it particularly fascinating. He took a moment and argued that Iran may have drawn a lesson from its relatively restrained response to, I think, what was called Operation Midnight Hammer back in June 2025. And what he said was, at the time, Iran's retaliation was largely symbolic. Yet the current U.S. administration returned with further strikes in February of this year, which has led to the conflict we currently find ourselves in. And in Sir Robin's view, Iran may have concluded that a measured retaliation simply just does not pay. And I think that leaves us in a very different, potentially more dangerous scenario. I'm not a geopolitical expert, but we appear to have entered a war, what I would call like a war of attrition, in which both sides may find it increasingly difficult to back down. Iran may believe it can outlast the current U.S. president, while the American administration arguably has limited options for an off-ramp. And that would leave Iran with some degree of leverage over the Strait of Hormuz, which would be detrimental to the price of oil for some time. Of course, it's anyone's guess what happens from here. But one plausible scenario is that the conflict drags on and oil prices, which I believe are back up to $80 today, remain elevated for much longer. And if that happens, the consequences would extend well beyond energy markets. I mean, it could affect inflation that Sarge just alluded to, economic growth, which you've been alluding to. From an international perspective, I think the currencies of major energy importing countries are definitely under more pressure. I was in Japan and Korea a few weeks ago, and they're definitely feeling the effects. So I think what I'm trying to say is it's those second order effects and the externalities that we're now working through. And we haven't changed portfolios, and we never really have direct exposure to the commodity price, but I think we're paying acute attention to those aspects of the portfolio where they provide either the durability or the hedge to an extended conflict and disruption in the energy markets.
Yeah, I think it's a fair point to say this is far from over. And the question is, have we proven anything about the resilience of supply chains and the ability to reroute, or are we just waiting for some delayed effects? And if this drags on for 6 months, 12 months, 18 months, is this just a drag on economic growth and an upward pressure on inflation that's pretty unwelcome given what we just outlined as a more precarious growth situation that's pretty heavily relying on AI? Sarge, shifting back to AI, we've talked a lot about it already and a bit about the concentration. Just to highlight a couple of statistics, we've been talking a lot about it internally. Semiconductors are now about 20% of the S&P 500. Technology is 40% or thereabouts, and that concentration is bleeding into emerging market indices and elsewhere in the world. How are you approaching this new surge in market concentration? And maybe a more fundamental question is just like, how much do you care, do your clients care about these benchmark weights? And do you think this kind of market leadership is sustainable, and do we need to manage to it?
Yeah, it's a question we spend a lot of time on. And maybe before I jump into that, I'll take a step back and say, for endowment and foundation clients, the starting point is generating returns that can offset spending plus inflation. We are trying to generate returns that allow the real value of those endowments to grow over time so that they can continue to fund their missions into perpetuity. And so the number one focus from a return perspective is really on generating absolute returns. And if you think about that kind of spending plus inflation number, it's probably in the 7.5% to 8+% range. So that's really what we try to stay focused on. At the same time, relative returns do matter. It's a way that we measure ourselves, and it's certainly a way that our clients measure us over long periods of time. They can obviously invest in very low cost passive indices, and they want to know how we're performing relative to that. And as the index has become more concentrated, this question you're getting at, as it's become more concentrated, it's actually become the biggest source of differentiation for probably many people's portfolios. You mentioned semis at close to 20% of the S&P. I believe that was closer to 5% a few years ago. When you put that in perspective, if it were a standalone sector and not part of IT, it would be the largest or the second largest sector in the S&P. 2 times as large as the entire industrial sector in the U.S., 2 times as large as the entire healthcare sector in the U.S., nearly 2 times as large as the financial sector. So this is something that you just simply can't ignore, and you shouldn't ignore, because there have been some great opportunities in that space. One of the things that we really focus on is just tracking our exposure and understanding what it is. With each client portfolio on a bottom-up basis, look through exposure to all of these different sectors across the market, and that allows us to make more informed decisions about what we have and what we would like to have. In short, it does matter. It's not our primary focus, but it is very important what's happening in indices. Is it sustainable? History would say no. We've seen this play out a number of times historically, with different sectors moving to be much larger than they have normally been. They generally always revert back to some level. The timing on that is really the catch. As we've talked about a bit here, and I know you've talked about in other settings, Sid, this could be a multi-year build out. This is really a generational technology that needs a tremendous amount of CapEx to build it. And so the timing of that is what really matters. And that's why we pay attention to opportunities on the semi side and think about that index concentration. But I do think it also does increase the risk that is inside these benchmarks. So traditionally, you'd think of investing in a passive investment as a way to get broad exposure to the U.S. economy, to the global economy. That has really changed over the past few years. You are now generally getting exposure to some of that, but mostly what you're getting exposure to from just a dollar perspective is large cap AI and technology companies, and the volatility of the market is even more driven by these areas than just what the exposure numbers would present. So over half of the S&P volatility in the S&P 500 has come from the top 10 names in the index, which are predominantly technology and AI related companies. That's a very high number. And so the complexion of the index has changed. One of the things we've tried to do with our clients is just help them understand that this is not the index you probably would have been investing in 15 years ago. It's not the quote unquote safe, broadly diversified index. It may be a good investment from here, but it is very different than what it was.
Yeah, and the top 10 doesn't even include a lot of the more high-flying semiconductor names. Yeah, they're getting up there. And to the volatility point, right, that's been added on by all of these levered ETFs and all the options trading, which has made the volatility in those names much higher than some of the traditional quality free cash flow generating companies that have made up big chunks of our portfolios in the past. So it is definitely adding to risk.
Yeah. I'll turn it back to you, Sid. On the AI side, this was a couple years ago, a question of what is this thing? Is this a real trend? Is it really going to be driving markets? I think we've moved past that. And now the conversation has turned to what level of return will be generated from this AI spend and who will capture the value. How do you think about that?
I guess I think about it a couple of ways. There's two ways I've liked looking at this. One is best we can at a high level. What are the revenues coming from AI and what are the ongoing costs of the infrastructure? And then at a more fundamental company level, what kind of returns specifically are the model companies getting? So on the high level view, there's an interesting new piece from a research firm called Exponential View, which tried to tally up all the revenues going to the hyperscalers to rent out their AI cloud services. For the past 3 quarters, revenues have been greater than the depreciation expense on this infrastructure. So the last quarter puts annualized hyperscaler AI revenue at about $100 billion versus $80 billion of depreciation. So there's signs of a return there as revenues ramp. Now that's just the depreciation expense. There are other expenses that should go against that. But I think there's a sign that there is a return. And really, the last 3 quarters is the first time we've seen that turn positive. If you add in the model company revenues, we're more like around 175 billion of annualized AI revenue. We don't have great data on all of the expenses for those companies, so we can't do that same net math. But I think it's safe to say when I go into the next part talking about some of the individual model companies that we would assume there's a positive return there. I'd note revenue for these AI companies are ramping 3 times faster than prior spending waves like the internet or mobile or SaaS. So the picture's changing really quickly. And, I could say fairly right now, companies haven't yet earned great returns on these investments. But we have to remember that with the first wave of cloud computing, for instance, and Azure and Google Cloud and what have you, AWS, it was years and years of these companies losing money on this investment, which eventually was a great business and the one that's driving those companies today. It appears that we're actually getting to some return more quickly in this cycle because of how fast the revenues are ramping. And if you look at the model companies, the best data we have is on Anthropic, into which we've made a pretty large investment through some of our managers. In Q2, they reportedly had 70% plus gross margins. Also, reportedly, were not just profitable, but free cash flow profitable. And analysis that we've seen suggests that 12 months after the launch of their latest models, they were generating revenues that were about 10 times the cost of training them. So implying a pretty good return on invested capital for designing and training these models. And if you look at the revenue side, the 2 big model companies have added 40 to 50 billion of annualized revenue this year. Actually, really, even just Anthropic has done that. That's more than twice what any hyperscaler has ever added in revenue in any quarter from their cloud businesses. So this is changing really quickly. The revenues are growing very quickly. And I'd argue there's pretty strong proof that these model companies can be great businesses. And I'm sure we'll talk about how that could change and open source and what have you in the future. But right now, I think the trend suggests we're approaching a time when it will become more evident, more obvious that these investments are generating a good return. So the question we need to ask is, will the revenues continue to ramp faster than expenses, just as they have the last few quarters? Are these revenues just kind of experimental budgets where the companies aren't seeing a real return, or the result of unconstrained budgets that are soon to be cut? All this news flow about token maxing and people blowing through their budgets for the year. So the questions are really core here. And to those questions, I'd make 2 points. So one, over the past year, the percentage of S&P 500 companies that have quoted specific quantifiable financial benefits from AI has gone from 10% to 20%. So we're hearing more about the benefits from these companies. That's still only 20%, but it's doubled in the past year. And the second point is that the spends today are just really small. So Uber was in the news a lot about they blew through their token budget in the first 4 months of the year. But that AI spending that they were talking about, and they're at the frontier of spending, it was 0.2% of their revenues. It was about 1% of their EBITDA and 0.5% of their labor costs. So I just think we're pretty early in what this spending could become. And that's why I'm tracking this data so religiously. The stakes are high, and it is really important. Where is this going? Kif, what about you? What do you make of the concentration in the market and this question of evidence of return on investment?
Yeah, thanks, Sid. I think a lot of the things that you touched on are similar to my remarks. And I touched on some of these points a little bit in my open remarks. But I think the most important question isn't whether technology is 40% of the index or semiconductors are 20%. The more important question for me is whether AI continues to be a meaningful driver of economic growth. And a minute ago, Sid, you alluded to the fact that I think in 2025, AI or AI-related spend was something on the order of magnitude of 40 to 50% of U.S. GDP growth. And if you believe, as I do, that that kind of participation in GDP growth in the U.S. and I think other markets is going to be either tied directly or indirectly to AI and AI-related technologies, then it stands to reason that some subset of the technology sector should continue to benefit, regardless of its weight in a benchmark. I don't think we want to be structurally underexposed to a trend of that magnitude personally. And that's just not based on market data. I mean, we see the productivity benefits of AI in our own workflows here at Brown Advisory. And we hear similar stories from many of the companies and industry participants that we speak with. I think all those sort of data points come together that give us confidence that this is more than just a market narrative. Now, does that mean today's market leadership is permanent? Probably not. As I mentioned earlier, I think we're still in the installation phase of AI, which means leadership is likely to evolve as the ecosystem matures. So while I don't spend too much time worried about benchmark weights, I do spend a lot of time thinking about where the economic value is likely to accrue over the next 5 to 10 years. Now, the nice thing about our portfolios is that we don't have to make an all or nothing bet. If AI continues on its current trajectory, I think we have plenty of exposure to participate in that opportunity. If it doesn't, we own a diversified collection of high quality businesses across sectors that we believe will continue to compound value over the long term. So it's a situation where I think if it continues, we're going to participate. If it doesn't continue, I think we have good balance and diversification. So for the most part, I feel pretty confident about our positioning. But getting back to sort of a more detailed and nuanced question that you alluded to with respect to models, maybe if I put it back to you, one topic getting increasing attention is the competition between open source models and closed proprietary models. How do you think about that debate from an investment perspective? Does it change the overall sustainability and spend? And also, where does the value accrue in your mind?
Well, this is one of the questions that's being asked in the AI ecosystem right now. And I'd say, first off, open source is performing really well. Chinese models like GLM5, Kimi K2.5, DeepSeek V3, Qwen 3.5, they're all scoring well on AI benchmarks, and we can see that they're gaining share as a percentage of tokens processed. They're cheaper than the frontier as well. And the last couple of months, I think a lot of companies are asking themselves, which of their tasks do they need the frontier model, the Ferrari, to perform versus the cheaper open source or open weight model, the Toyota. And I think there's some good data from a company called Open Router, which helps companies route their AI queries to the most appropriate models, which gives us some insight into the trends. It's likely, to be fair, I think a bit biased towards the open source, as most of the large companies like Brown Advisory, aren't using a service like this. We're just directly contracting with OpenAI or Anthropic, but I think the data is useful nonetheless. And that data shows that while open source has grown its share to about 50 to 55% of tokens processed, its share of the revenues that are coming through is still only about 10 to 15%. So 85 or 90% of the dollars spent on AI are still going to the frontier, and that's predominantly Anthropic, OpenAI, and Google. And this hasn't changed. We have data through June since these recent concerns over token maxing or the news articles, the Uber news that I referenced about how expensive AI has become. And I think two reasons for this are, one, the sticker cost of open source doesn't capture all the actual costs. It's a price per token. And these open source models take more tokens to produce the same output, and they still aren't as intelligent as the frontier. So I've heard some analysts say that you need to multiply the sticker price by like 5x in order to have an apples to apples comparison. So instead of being like a 90% price discount, it's maybe more like a 40 to 50% price discount. And even then, you might be getting work back that you need to fix more of. The second point is that we're so early in the adoption of AI. The frontier labs like Anthropic spend $2 million per employee per year on AI tokens. The top 1% of companies today are spending $100,000 per employee per year. The median company spends $100. So as companies are going to spend more money, I think they're going to go first to some of these known brands, the quality companies at the frontier, as they go from that $100 to something higher. And the Fortune 500 companies want the best. And the data and the commentary seems to suggest they're getting a good return on that spend. Again, that's one of the big questions. So if that changes, I could see it two ways. One way is open source winning is actually bullish for AI and AI infrastructure, right? If they're able to provide the same service at a lower cost, it leads to even more use and more demand. Another way you could look at it is, well, if the frontier labs are the ones who are supporting all this spend today and they have all these big commitments that they can't meet, it could be a pretty awkward handover of those computing resources. So my actual view is that I think both are going to win to some degree, and the revenue split may move a little bit more towards open source, but it'll stay mostly at the frontier. And the highest value tasks and the research and the coding work and the review work, the real intelligence is going to stay at the frontier. And some of the more mundane tasks are going to be done by the open source. I also think we could see the frontier potentially expanding their lead and those benchmarks starting to look a little bit different as these models start to train themselves, this recursive learning. And the frontier labs use their capital and their huge talent advantage to compound that lead. We don't know, but that is, I think, certainly something that could happen. And one thing I think we all have to remember is like right now, it appears both open source and frontier are good businesses. Anthropic has those reported 70 to 80% gross margins. Open source players are supposedly even higher than that. So if the model companies are making money, and importantly, the costs of compute continue to come down because the models are getting more efficient, the chips are getting more efficient. As their costs go down, even if their prices are coming down, which is good for demand, their margins are increasing. And I think that's the big story of this year is that like inference margins actually look pretty darn good. And it should continue to support investments in AI infrastructure. So all this being said, it's a very fast moving space. I reserve the right to change my mind. And that's why I think we're all spending so much time on the topic. Kif, back to you thinking about China's growing AI ambitions, think about government support, export controls. How should investors think about China's role in the global AI race over the next decade? It was interesting to note that China's begun considering some of their own export controls. We've seen a few of these Chinese models decide that they're going to go closed source, perhaps as a response to what they're seeing from the U.S. labs and also the U.S. government's recent controls of leading frontier models from Anthropic and OpenAI. How do you see this playing out? What is China's role over the next 5 to 10 years?
It's a really good question. And I'll preface it by taking a line that you just used. I reserve the right to change my mind. At the risk of laboring the point, it is such a dynamic and changing technology that every day I think we wake up and we see a new data point or a new company or a new methodology. It's just fascinating to be in the seats we're in right now in this period of time. But specifically with respect to China and the US, I don't think it's an overstatement to say that both see AI supremacy as somewhat of an existential risk. They're effectively, I think, in many ways, in an arms race over AI leadership. And I think it's fair to say that China and the US both view AI as strategically important for economic growth, for military capability, for scientific research, for national security, for all the issues that really affect, I think, a domestic policy. And so what does that mean from our perspective? I think it means two things. The first thing would be you just have to respect China's ability to innovate, develop, and create infrastructure, investment solutions, models, anything along the AI spectrum across the platform. And I think you just have to be aware that it could happen at any one point in time. I think one of the interesting points in speaking to a technology team that we invest with here in London, they've been doing it for 25 years. And I was asked the question, in the technology stack, if there were one or two companies that you would hold for 3 or 5 years and you couldn't touch, let's just say you put them in your children's account, what would they be? And they both hesitated and said, I couldn't give you one. Well, maybe I could give you one. Maybe it would be NVIDIA. But it wasn't sort of the Microsofts, the Googles, the names we know quite well. And one of the points they were trying to make is, again, the ecosystem is just changing so rapidly. And there are many names in China that you haven't heard of today that you're likely going to be hearing from in the near future. And I think we just have to be humble to sort of China's ambitions. That's the first thing. The second thing I would say is I wouldn't necessarily bet that American companies, or I would say non-Chinese companies, those in the developed West, if they need supply, because we're talking about supply constraints, that they won't turn to Chinese solutions. I think there's some national security risks around this. So some of the bull cases for Samsung and SK Hynix in the memory space are that maybe some companies would never buy from a Chinese supplier. I've heard others in the market say I wouldn't necessarily bet on that because the Chinese suppliers are really trying to ramp up and reach the level of competition that the South Koreans have been building for the past few decades. So again, I think it's about keeping a close eye and remaining sort of open to what is a very, I think, considerate and determined path on the part of the Chinese to really develop that AI infrastructure. Sid, if I could just pass it back to you. I know you and I have gone to China many times. I'm curious your views on China's role. Just overall, how are you thinking about the portfolio allocations, where value ultimately accrues? What are your thoughts on the subject?
Well, I would first say China is clearly the leader right now in open source, and they're nipping at the heels of the U.S. model companies. I think some of this is through the incredible ingenuity that you just described. And this is despite huge resource constraints and export controls on NVIDIA chips and what have you. It's also maybe potentially through some cheating and distillation of U.S. models and tens of thousands of fake accounts that are trying to figure out what Anthropic and OpenAI are doing. I guess I'm probably still of the view that many large Western companies are going to prefer to use Western open source models as they appear. Even if they can host these models themselves locally, I think they're probably going to prefer to use Google, or NVIDIA has an open source model, or Meta, or someone else. And I think we will have US open source models that can compete. And as I mentioned before, it's interesting to see some of the news that some Chinese labs, Alibaba, Zipu, Minimax, they're going away from open source and they're going towards closed. I don't know what to read into that other than that we may end up with just two separate ecosystems and maybe somewhat disparate client bases. As for where to invest dollars, I would say we don't have a lot of dollars invested in Chinese AI companies. I'll give you one interesting statistic. One of these Chinese model companies, Zipu, I hope I'm pronouncing that correctly, is a public company in China. It has a $100 billion market cap, and its revenues for this year are projected to be $500 million. So when you compare that to Anthropic at a 900 billion market cap, where the revenues are rumored already to be over $60 billion, it seems clear to me where I'd rather have my money invested and where the customers are concentrating and where the revenues are. Again, could change in the future, but right now it still appears to me like the better opportunities for investment are in the US. Speaking of public companies or newly public companies, Sarge, we just made it through the record-breaking SpaceX IPO, performed relatively well. One of the Korean companies that you referenced earlier, SK Hynix, just raised the most ever by a foreign company on a US exchange with their ADR listing. And we got a full pipeline: Anthropic, OpenAI, Databricks, Stripe, all sorts of companies waiting in the wings. What are you thinking about as we see these mega listings in the US? Are you concerned about the market absorbing this supply? Are you worried about the future compositions of benchmarks, shifting even more towards technology? What are you thinking about, and are you doing anything about it?
Yeah, I guess first off, I think it's a real positive that these companies are coming public. SpaceX, OpenAI, Anthropic, these are some of the largest companies in the world already. SpaceX now public, as you noted, but being on a level playing field with the rest of the public companies with that public disclosure, price discovery, which can be good or bad, but I think that puts them in a spot where it's just better for the investment world when these companies are public and reporting on a consistent basis. I think the ability to absorb this capacity is going to be a really interesting topic. And SpaceX is probably the one where it's most front and center. That company's been private for well over a decade. Institutions have built some very large positions in that. And it's a great problem to have because it has compounded and grown so much. But there are institutions with 10, 20% of their entire portfolios in SpaceX. I'm sure it was never meant to be, with maybe the possible exception of a couple places bigger than 1 or 2%. And so for risk management purposes, as these locks come off, they're going to have to rebalance and sell some of that exposure. Now, on the other hand, there seem to be no shortage of people who are interested and willing to back Elon Musk, and he's done some pretty amazing things. And so how that balances out, we'll just have to wait and see. I do think in the end, what will matter is valuation. And so for SpaceX in particular, because that one is already public, can they generate cash flow and earnings that underpin that valuation and also provide new investors the ability to generate a good return from here? And I think that's a really open question for them. The one thing that you just pointed this out, for the model companies, the growth we're seeing is so different than what we've seen from large companies in the past. And so I think it's a little bit of a trickier question than just looking at a PE multiple or something like that on SpaceX. But really, in the end, what will matter is, can you earn a good return by buying these companies today? What we're doing, we are also investing in some of these companies in the private market. So OpenAI, Anthropic are both prevalent in our E&F portfolios. Some of that is just an acknowledgement that these are very large companies and they matter. But the biggest driver has just been that they're companies that, and you know this well, Sid, that some of our highest conviction managers believe are incredible value propositions from here. And so they're really more opportunistic investments than anything else. What about you? How are you thinking about these IPOs?
Well, I've thought a lot about just the story the last 10 years has been we've had more buybacks than stock issuance. You know, it's kind of been a shrinking pool of companies you can invest in. And so marginal dollars have to go to the existing companies. And as companies buy back their shares, there's just a supply demand dynamic that's been very positive for markets. So I definitely worry that we could see issuance this year that pushes us to a positive net issuance versus the negative that we've seen for so many years. Looking at the pipeline today, I still think we could see negative net issuance again, so more buybacks than net issuance. But buybacks have been slowing a little bit, so that could be off. So I'd say on the margin at a high level, it makes me a little bit more cautious about markets and valuation. As for benchmarks, I'd certainly be personally excited to see Anthropic and OpenAI in the benchmarks. And I would note that given all these companies are being weighted relative to their free float, so they take into account the big insiders who won't be selling their shares, that reduces the weight that you see them in the benchmarks. They're not going to be too large to begin with. That was particularly the case with SpaceX. It isn't in the S&P yet. It's about 1% of the NASDAQ and an even smaller position in the FTSE and the Russell indices. And I think that'll be the case with a lot of these companies coming public, that it won't dramatically impact what we get if we're a passive investor. And then to your point, yeah, it's all about the fundamentals. Can they deliver? I would say that the pipeline of companies, maybe barring SpaceX from a valuation and conviction standpoint, still seems pretty high on the list of many of our private managers of things that they like to own at the current prices and they think will generate good returns going forward. Just shifting to earlier in the life cycle, Sarge, emboldened by these huge outcomes, we've seen a big rise in the price that venture capitalists are willing to pay for stakes in even earlier stage companies. I think the median seed stage valuation is up 40% just this year. And the largest size deals, the top 5% of the biggest deals, the prices are up 200%. What do you make of this dynamic? And more broadly, how are you approaching private investment commitments and portfolios today?
It makes me nervous. I feel like we've seen this before. There are some similarities, very different end markets, but some similarities to what we saw in the venture capital and growth markets in 2021. And I think that there are very clearly going to be some great companies that come out of these vintages. And so I think there's some great opportunities, but this is a time where I think it pays to be very disciplined in how you invest in private markets. So when you think about how we're investing for our clients in the endowment and foundation space, we are building asset allocation plans with them upfront. Part of that is building a target to private equity that meets their risk tolerance and is one that they're comfortable with. And then we look to build that exposure over a number of years. It takes time to build your private commitments. It should take time. This is a multi-year process, and we really look to be sure that we have vintage year diversification across different strategies, so venture, growth, buyout, real assets, credit. And so it's times like this where I think it's particularly important to stay disciplined. It doesn't mean we can't be opportunistic. We have been in a couple of co-investment cases that you mentioned. But what we want to be sure we're not doing is over-investing to vintage years like this one and venture and growth. And so really want to be sure we're sticking to that plan and continuing to build diversified private portfolios.
Kif, shifting away from private markets and just all things international, you just got back from Asia. Could you talk a little bit about what you see as the investment opportunities over there? I know we've had this Japan investment. How is that thesis playing out? We talked about some of the dynamics driving emerging markets. We've talked in the past about higher U.S. rates and a strong dollar. Wrapping it all together, what does the opportunity set look like overseas today, and how are you thinking about it?
Great. There's a lot to unpack there, and I'll try to do it pretty succinctly. As you alluded to, I was in Korea and Japan a few weeks ago, and it wasn't too long ago that I spent a week in Singapore. And the first thing I would say is every economy and sort of every structural growth story is very different across Asia. Maybe I'll start with Japan. You mentioned the corporate reform story. I think I did something like 17 meetings over the course of 3 days. And this question came up time and time again, and we keep hearing the same consistent answer is, yes, the corporate reform story is real. Yes, it's more about evolution, not revolution. Companies are embracing it. It's on the margin. I think having active management that understand the ecosystem is especially important, and also having active management that can sort of invest along the spectrum, not a pure growth manager, not a pure value manager, but one that really has the flexibility to go where the opportunity set exists. Because what we've all learned about Japan over many years is there are periods when the growth-oriented companies in Japan are totally leading the market, and then sentiment can shift quite quickly, and it's the value companies that do well. So it's an area that we continue to be constructive on. I think that's the case. More broadly about Japan, and this I think relates to Korea and India as well. If you think about the energy importing countries across Asia, we're seeing greater pressure on those currencies, particularly when energy prices are elevated, specifically what we've seen going on in the Middle East. And I think that's going to continue. And that really elevates the inflation rate to a degree. And that's something that we heard time and time again. With respect to the broader EM story, I think in some ways the approach is very similar to how we think about Japan, is There's just a lot of nuance there. And I think, again, not to belabor the point about active management, but I think active management really plays a role in how we think about EM companies more broadly across the portfolio. So quickly by way of example, I think we also saw Chinese GDP growth today coming out lower than expectations, lower, I think the lowest it's been in the past 5 years. And you see sort of this bifurcation where the domestic consumer story or consumer sentiment in China is really, really weak, but you have an export story that is very, very, very strong. So we have exposure to some of the exports that's related to the AI theme, but we have little exposure to some of the consumers. That's something to keep in mind. On the broad EM index, again, the names that continue to dominate, the tech names, the Hynixes, the Samsungs, we get plenty of exposure to that through other parts of our portfolio. So perhaps, and we're doing a little bit more work on this, finding an EM strategy that can find alpha or pockets of alpha in other parts of that market as we think about the whole portfolio. That's something under great consideration. And then, as I think about India, I think it was just 2 or 3 years ago where India was all the rage. Valuations in India really got to, for lack of a better description, nosebleed valuations. I think a lot of those have come back in. And despite being an energy importer, I think the domestic story there seems to be fairly well from our conversation. So that's a very long-winded way of saying, yes, we think the opportunity set is there. Yes, we have to be cognizant of both the macro factors and the geopolitical factors. But if we think about EM as not just an EM manager, but how we get exposure through a variety of managers in our portfolio, I think there's a real good opportunity set.
Well, Kif, that's more positive than I feel like I've heard you on international markets in a while, though I guess we avoided talking about Europe. So maybe that's why. For both of you, you spend a tremendous amount of time with clients. What is the question you're getting asked most often today? I'll stick with you, Kif, and then go to you, Sarge.
Yeah, I mean, look, the question we're getting most often is you have relatively little exposure to some of the companies and trends that are driving the market. What are you going to do about it? And I think it's a completely fair question. And the answer is that we have been doing something about it. I just hope we've done it in a thoughtful and disciplined way. I think it's worth reminding ourselves that this period of technology-driven market leadership is still relatively young. It's only been about 3 years since the public launch of ChatGPT. And I think because we report and evaluate performance on a quarterly basis for many clients, I think the current market environment can feel, as though it's been in place for much longer than it actually has. And we have spent roughly the first 18 months observing the trend and trying to understand whether it's cyclical, speculative, or something more durable. And I think over the past 12 to 18 months, we've spent a significant amount of time researching the opportunity set, building confidence in the duration and scale of the cycle, and making sure that it has real merit. And I think at this point, we have confidence that it does. So we are now at a point where we're looking to add more direct exposure across balanced portfolios. Those are technology-specific investments. And the goal is not to sort of chase what has already worked, but to participate thoughtfully in a structural trend that we increasingly believe has staying power. So I think that's the question. That's how we're addressing it.
And relative is the key word there, right?
Yeah,
because
absolutely.
What is relative has changed so much, even in the last, 2 or 3 years. Keeping that in mind. Sarge, what about you? What's the number one question you get?
Yeah, it sort of rhymes with what Kif just said, and it's really around why don't you just index all of your public equity exposure? Over the past decade, the S&P has compounded at just above 15%. The MSCI All Country World Index is nearly 11%. So these are numbers that if you go back to that absolute return kind of framework I was talking about earlier, these are numbers that get you there. So why go through the trouble of trying to find great active managers around the world and build these diversified portfolios if you can just put it in the S&P? The answer is really around some things we've touched on already. The S&P is not what it used to be. And so that level of concentration has really changed the risk dynamic of passive markets. And when you put that into a forward-looking context, looking at valuations and trying to predict the direction of markets is relatively futile over short periods of time, but over a 7 to 10 year period, there's a pretty strong correlation between the starting valuation, what you're paying for an asset, and the return that you get on it. And based on our numbers, and these are pretty consistent with numbers we see from other market providers, you're looking at more like 5 to 6% returns for passive indices over the next decade or so. Now that obviously can ebb and flow, and AI could change that in some ways. but it's not a bad starting point to be thinking about. And if that's the case, those numbers don't get you there. They don't get you to an absolute return hurdle that allows you to continue to grow your pool of capital and do that in a real way with your spending needs. And so we just think it's not the solution going forward. It has been a great solution historically. And we think that passive can play an important part and role in portfolios, and we do use it. But that is not something we think that is a full solution for portfolios.
Yeah, and it's tough where you look at the 5 to 6% projected return, and then you speak to some of these concentrated stock pickers who are underwriting their entire portfolio at some of the highest prospective returns they've seen in a while, mid-teens, like forward-looking returns. And certainly, if for nothing other than diversification, you think it might be beneficial, but maybe on an absolute sense, you'll be better off. And this is the tough thing, is that the review mirror tells you aren't. But we as investors have to be thinking about the go forward. So I think it's a really, really fair point. Another quick lightning round question for both of you. As you look ahead, what do you see as the most compelling opportunities? I'll stick with you, Sarge, and then close with you, Kif.
Yeah, a couple of things. The boring answer is that we just continue to find opportunities one at a time. So when I think about 3 of the most recent investments we've made in our endowment and foundation portfolios, they are a small cap opportunistic manager in the U.S. managing a relatively small fund, had room for one more investor. This is a long-term relationship for our team and one that we were able to come in and take that last spot. Another was lower middle market buyout fund that has done very well for a number of years. Our private equity team here at Brown Advisory has spent years building this relationship and getting us access to that fund. And that's another one that we have most recently committed to. And then a co-invest fund that we've done with a growth equity manager that's giving us exposure to some of the companies we've talked about on the private side, some of the most exciting and compelling opportunities out there in the private markets on a low fee basis. I think on a broader level, coming back to what I talked about earlier, really thinking about what do we do with some of the managers in our portfolios who have distinguished themselves for many, many years and are having a very tough time in this market environment. I think it's not quite as easy as just saying you should give them more capital, because the market dynamics have changed and we need to be sure that they are staying on top of that and can perform well in the world we're in today. But leaving space open for holding those and potentially adding to them is something that is top of mind for us as well.
Kif, what about you?
I sort of maybe build on how Sarge started. It's a bit of a dull answer. I think probably some listeners would want to hear SpaceX, Anthropic, or some kind of private AI company that we can help get access to that's going to be the next multi-bagger over the next 3 to 5 years. But despite that, actually, I think some of the most compelling opportunities today are actually in the companies that the market has labeled as potential AI losers. And in several cases, we think the risks have been vastly overstated, creating really attractive entry points for long-term investors. It's not the most exciting story, but I think it's the one that actually holds the most merit, I think, in our portfolios here. One example is London Stock Exchange Group, which I was discussing with the client this morning. The stock has experienced multiple compression as investors have really focused on perceived AI risks, but we believe the underlying business is far more resilient than the market expects or appreciates. And while it has been painful to see the valuation come down, we think it's created a really extremely attractive risk-reward opportunity at today's prices. I think where we used to underwrite low teen IRRs, which would be a great entry point for us in sort of core portfolios, I think we see high teen or private equity-like returns in a lot of these publicly traded businesses today. And I think it's not the most emotive or exciting answer, but I think that's where we see the opportunity. Quickly on Europe, I mean, you mentioned I've been sort of bearish on the European economy for some time. I think that certainly continues for a lot of structural reasons. But beyond equities, I think there are some really interesting opportunities in the European private credit space, particularly in strategies that provide liquidity where banks or other institutions are constrained. So you can buy high quality credits that financial institutions want to get off their books for a variety of reasons at very attractive prices. So while it may not be a growth opportunity, I think it's a very interesting value opportunity for unique strategies. And not only do you get a return profile, but hopefully you get asset classes that are less correlated to public equities that can provide the diversification, the income, and some of the other portfolio management benefits that both, I think, create the balance, but also provide that absolute return opportunity that Sarge has been alluding to rightfully over the past few minutes. So those would be the 2 areas for us.
That's great. I think for all of us, we have to remember we got to keep doing the day job of finding the bottom up opportunities and keeping the absolute return in mind. And obviously, we're spending a lot of time on AI, but none of us want 100% of our portfolios to be marching to the beat of that drummer. Well, thank you both so much for spending the time. This was such a fun conversation. It's such an interesting time in markets. Thank you both for joining. And thanks to all of our listeners. We'll see you next time.